Welcome everyone to the sixth in a series of videos that explains how to complete the financial statement and analysis system spreadsheet. This spreadsheet is part of the University of Wisconsin Division of Extension's Farm Management Pulse program. The link you can see at the top of the visual. The spreadsheet itself can also be found at Developing a Farm Financial Model website, and that link is shown at the bottom of this page. My name is Kevin Bernhardt, and I'm both a farm management specialist for the University of Wisconsin Division of Extension's Farm Management Program, and I'm also a professor at the School of Agriculture at UW-Platteville. This video introduces and explains how to complete the balance sheet schedules I and J, which is for valuing machinery, equipment, and real estate. Like the breeding livestock video that we had just before this, these assets are capital assets, and therefore they do depreciate. Depreciation itself is a bit of a challenging subject. So just as a reminder, there is a video on depreciation titled Depreciation. So let's get started. I'm going to bring up now the spreadsheet itself. It's on machinery and equipment. It's on Schedule I. And you can see the kind of information that is needed is pretty similar to what we needed when we were talking about breeding livestock as well. So we need to know what the acquisition cost is of each machine, each piece of equipment. We need to know what its accumulated depreciation is. And of course, for that, we need to be able to calculate depreciation to start with, and then multiply that over the number of years we've had the piece of equipment. And again, for more information on that, see the depreciation video. We also will talk about it a little bit more later in this video. And finally, we need what we think we could sell this piece of equipment for in the marketplace today. Now, in the case of Wisnet Farms, we've kind of cheated here a little bit because I do have three individual items: Tractor 1, Tractor 2, and the skid loader. And then I just lumped everything else together as other machinery and equipment. That's not the usual case. Normally, you're going to want to itemize out every one of those pieces of equipment, every one of those pieces of machinery. Obviously, there's not enough room to do that here in Schedule I. So we do have a separate depreciation schedule that we can do that on. So if you look at the bottom of the visual, I'm circling a tab right now that's called Depreciation Schedule. I'll click on that real quickly so you can kind of see it. And there we have a lot more room to put all the pieces of equipment and so forth down. Now, you don't have to use this depreciation schedule tab. It's only there for your use if you want to. If you have this information somewhere else in your records, maybe it's a part of your tax records, then you can use that as well. So we will, in the depreciation video, is discussed how to use this particular depreciation schedule tab. So you can see some of the entries that are already made here. Now, there is a spot for the date that the machine was acquired. You can put that in there, but that's just some extra record keeping for you if you want to use it, but you don't have to. It does not affect the calculations themselves. So just as an example here, we have this skid loader that hasn't been completed yet. The acquisition cost for this skid loader was $24,000. Remember, that acquisition cost is the purchase price plus any transportation or installation costs, etc., that took to get that skid loader ready to start using. Whatever that total was, in this case, it was $24,000. Accumulated depreciation was $12,000. And then we believe if we went out to the marketplace today, given the number of hours on that skid loader and given what people are willing to pay today, we believe we could probably get $10,000 off of that skid loader. Notice that's different than what the cost value is, and that's not unusual. So the total market value has nothing to do with depreciation. Well, it does have something to do with depreciation, but not mathematically. It's what you believe you can get for in the marketplace today. And in this case, for that skid loader, it was $10,000. Now, there might be a question here as to where did this $12,000 of accumulated depreciation come from? How did we get that number? So this is just a quick a quick summary of where that accumulated depreciation number comes from. Again, go to the depreciation video if you want to learn more. But a very common mathematical method to use for estimating depreciation is what's called straight line depreciation. And the formula for that is acquisition cost minus salvage value divided by useful life. And that gives you annual depreciation. And it's going to be the same for every year of that asset's useful life. And then you accumulate it, you just multiply it by the number of years that you've had the machine. So in the case of the skid loader that we had before, that skid loader had $24,000 was the acquisition cost. The salvage value, which wasn't given before, but I'll tell you now, was $4,000. So that means we believe at the time we purchased the skid loader that if we used it for the useful life of 5 years, it would be worth $4,000 at the end. So we're going to take that acquisition cost, subtract off the salvage value, and divide it by the useful life, which is 5 years. And that turns out to be $4,000 per year. Happens to be the same as the salvage value, but certainly wouldn't have to be. So that's how much depreciation there is per year. Now, to get the accumulated depreciation, we have to multiply that times the number of years that we've used this asset. And in this case, we've used that asset for 3 years. 4,000 times 3 is $12,000. And that's where that $12,000 comes from. Note in this economic depreciation, if we thought we were going to use a skid loader until it dropped and it was going to be worth nothing except for junk at the end, our salvage value could be zero, or whatever value we get from taking it to the junkyard, so to speak. So that's a bit of a game to play with this. We'll talk more about that in the depreciation video. Now, that's machinery and equipment. Let's go on here to Schedule J. Schedule J is for real estate, and real estate includes land, their personal residence, the farm buildings, and any improvements that you have put into those buildings or even on the land, like an irrigation system, for example. So Schedule J is split up into different blocks. The first block is personal residence, if that's separate from the rest of the farm. The next section is land and land improvements. You can see me circling it there on the spreadsheet. And the third section is on buildings and improvements. Again, I just have, like for the case of buildings and improvements here, I just have a total. However, in what you'll want to do is have a schedule of those itemized out. Maybe there's enough room here to put your buildings in. If not, you can use something like that depreciation schedule that we referenced earlier. Okay, so for all these, you have fairly similar information requirements. What was the acquisition cost? What's the accumulated depreciation? And what's the market value? So, and then there's some extra things too. So for land and land improvements, we want to know acres, and there may be some different pieces of information. But for the most part, what is the cost? What's the depreciation? How much is that accumulated since the date you've had the building or the piece of improvement or the whatever? And then what's the market value? So we can look at these and see, for example, the personal residence was not separated out. That's just part of the land and buildings. So let's look at the land section itself. In the case of Wisnet Farms, we have two different farms, the original farm, and we had a Smith farm that was purchased later. You can see what the number of acres is for each. The acquisition cost per acre is there. The original farm was purchased a while back when prices were a lot less for land compared to today. Now, notice that there's zero accumulated depreciation when it comes to land. Why? Because land doesn't depreciate. So that's the one capital asset where we don't have any depreciation. Now, if we had a land improvement like drainage system or irrigation system, that would have depreciation associated with it. So the acquisition cost, the number of acres, that gives us the cost value for this piece of land, for these two pieces of land. That could be very different than what the market value is, as you know. In fact, quite often the land original cost or original price that you paid is very different than what today's market value is. And so the market value would be whatever you believe you can get for that land today in the marketplace. For the buildings and improvements, again, I just included a total here, acquisition cost, and the total accumulated depreciation. Again, we have the market value that we want to record as well. Okay, that about covers it now for both the Schedule J on real estate and Schedule I on machinery and equipment. Now that we're getting a little bit more used to how these schedules work, it kind of goes a little faster in terms of knowing how to complete them. The next thing we'll talk about is capital lease schedule. Capital lease schedule is Schedule K. This is more of an interesting one, and we have a separate tab on just analyzing leased assets. That will be the subject of the next video. Until then, thank you for listening.